All right. Hello, everybody. Welcome back to the channel. This is episode number 2 of Deep Dives. The first one we did last week was on ASTS. The second one we're doing this time is going to be on OSCR Health. This name in the past week has gotten a lot of people excited. The stock right now on Robinhood is up another 13% in the overnight markets after being up 20% 2 days ago. So about a 33% move in the past couple of days. If you've been long the stock for a while, if you've understood the thesis for a while, like Ronnie has, then you are having a lot of fun. Or if you got in literally 2 days ago, like Chris did, then you are also having a lot of fun. So the goal of these deep dive series, which we're probably going to try to do every other Thursday, is to pick a new stock, a retail stock that is getting momentum on YouTube and X, which we've seen Hims, Palantir, Robinhood, Rocket Lab. So many of these ASTS have been able to, quite frankly, change people's lives, because the collective due diligence of retail has been sophisticated and it's led to some astronomical gains. So today we will be talking about OSCR Health. I'm here with Ronnie, who's one of the main people on Twitter that's been talking about this name. And I'm here, of course, you guys know, with Steve and Chris. Steve wrote an article that I'll link in a second 2 days ago on OSCR Health, bullish. And Chris actually invested a little bit into it 2 days ago as well. So we'll be going through the thesis here today. Chris, Steve, Ronnie, how are you guys doing?
Great. Good to be here.
Yeah, the portfolio's green. Anytime the portfolio is green, it's a good day.
Steven Fiorillo, how are you?
Wonderful, Matt.
For those that don't know, I'm meeting Steve tomorrow in New York, and we're going to get lunch. So I'm also very excited for that. Steve, are you excited?
Steve, is that a new haircut? Got a new haircut, Steve?
You asked me that like a week ago.
I didn't ask you that.
Yes, you did.
No, I didn't.
Well, somebody did. Maybe Mitt or Matt did. No, I'd shaved today.
Oh,
Okay.
okay. Oh, we like it. No, you look good. You look dapper. I like it. All right. So let's get started. First off, Ronnie, I'm going to give you the floor. Who are you? How long have you kind of been investing? How long have you been in OSCR? And then give me the good 5-minute pitch on why you like this name.
Awesome. Yeah. So Ronnie, got the Ronnie V Show on YouTube, X. Been investing, trading for about 10 years. Air Force veteran. Been doing this full time now. Really just looking to continue to grow portfolios, find 10x opportunities while also investing in just great names. So really excited to be here. Obviously, I'm a small guy in this world. The beginning of my 10-year journey, I grew up. I just watched a ton of YouTube, watched a ton of finance YouTube, watched guys like Amit, Jeremy over at Financial Education. Watch a lot of these guys, and
we also love that you got the bricks, bro. We love that you got the bricks.
Yeah, the bricks.
I just want to say the Air Force is a bunch of pampered ass motherfuckers. But
yeah,
if there's every single regret that people have after they get out of recruitment is, man, I should have just joined the goddamn Air Force.
They're doing the Air Force. Yep.
Yeah,
pampered.
They're the smartest branch, but they're also the laziest. And they do like,
oh yeah,
the rumor is, I don't know if it's true. Maybe you can explain, Ronnie. Yeah. Y'all do PT on a treadmill. Like your 2-mile run is like, yeah, you just get on the treadmill and go do an elliptical run. Is that true?
No, we ran on the track, and everything. Yeah, but
what was your position when you were in the Air Force?
Air transportation. So got to basically move a lot of people in cargo, bombs, bullets, all that kind of good jazz. And then I did a stint in recruiting. So I was put people in the Air Force, help change lives, and yeah, it was awesome. It was awesome, but it was time for a change for sure. I'm so passionate about the stock market. I'm so passionate about investing and trading, and like I really feel like you can't do this like fully like what we're doing, what I'm trying to do, unless you have that passion. Like
you have to be obsessed with every syllable Jay Powell said.
I got a niche today. Like the stock market's not open. I'm sitting here like, come on, like what are we doing? I need
it's a bunch of degenerates, bro. It's like,
yeah,
I need to trade, bro.
I need it.
You guys could become crypto bros and have a 24/7 market.
That's not as fun though, dude. These are real companies going up and down. Like that's what makes it.
Yeah. I actually don't like the idea of the 24/7 market anyways. If we're gonna get into that, I'm not a big fan of that. Too widespread on the volume. But Oscar, right? So been in this name since February. I wasn't first. I wasn't last. You're not first. You're not last. Ricky Bobby, right? And you know, I'm always a believer. I was talking to Amit about this. I was DMing him, and you know, I really, you know, I don't think it matters. Like you could have gotten this name 2 days ago and be up massive right now, and you didn't miss anything. So I hate the whole like, you know, oh, you weren't first or anything like that. Definitely give props to anybody you saw this from, and you saw Oscar, you saw the due diligence. There's so many great names on X, Bull Trader, Bullfinder Trader, the Long Investor. You know, a lot of these guys just you know, very, very deep analysis, talking about this stock, and super bullish about it. You know, it takes a community to really like find these and get behind them, and then, you know, really get it going. But look, there is a, you know, my little 5-minute pit. There is a distinct comparison and just constant similarities between a lot of these companies you're seeing that are just killing it. The Palantirs, the Robin Hoods, the Hims and Hers, the Lemonade soon to be, the
ASTS.
Yeah, the SoFis. Like a lot of them, what they have in common is they are going after the younger generations. They're going after millennials. They're going after they're going after Gen Z, Gen Alphas, and maybe even you know, Gen Xers, right? And so what they're really aiming for is, we all know, you know, boomers, they got a lot of the money, right? They've had it like somewhat the best, some say. And, you know, this is only part of the thesis, but you know, when they pass, a lot of that money is going to get transferred down into you know, these younger generations. And when you have these younger generations already using Robinhood, or they can take their dad's you know, their dad's brokerage and with Fidelity or whoever, and they can get a 2% you know, cash on whatever they bring over, $1 million, 2 million, 10 million, 20 million, whatever, right? You know, them, SoFi going after the younger generation, making things simpler, people transferring over to them when they get that money or grow into that money. You know, all these companies, they just have that same factor. They're playing the long game here. They're playing that game of, you know, let's go after these younger generations because they are the future. So you have that, right? And then also with that, you have these companies. What are they doing? They have great software. Their integration and their software and their what's the word I'm looking for? Their oh man.
They're kind of tailoring to the youth with UI, UX, gamification.
Yes, they're making it fun. Like, yeah. Right, like Robinhood made it fun with the confetti and everything. With like, they made investing fun. They had little like things you could learn about the stock market and everything, and slide and, you know, get your little stock fix for the day, and, you know, here's a free stock for investing. Like, it's awesome. They're making it fun. Hims does it with their packaging, right, and their app, and like and just their customer service and the just how great it is to use their apps, right? And brings me, for all those companies, to what Oscar's doing. Oscar's doing that. And what else do all these companies have in common? They're all going after disrupting these dinosaur sectors, these legacy sectors that have not been disrupted at all, right? Robinhood went after free
trading.
Free trading, essentially. And then, you know, SoFi is going after the banking sector, and, you know, Robinhood's going after the brokerages, and Hims and Hers going after pharmaceutical and healthcare. Tempest AI is going after healthcare. Lemonade's obviously going after car insurance and other insurances. And then you got Oscar going after health insurance. And yeah, I just think Oscar, like, you know, where they're at right now, you add on how fundamentally undervalued they are. I've posted my high five snapshot like 1 million times. You know, I think on a discounted cash flow model, or $59 fair value, and that's after beating them up and going way under what analysts have. And then on an EPS basis, you know, 2025, I would say fair value is $20.46 based on where they are right now. And then forward, so 2026 would probably be about around $30.
Okay, so we'll talk more about valuation in a bit, and we'll talk about your projections as well. Okay, so the TLDR, Oscar, is health insurance for millennials, Gen Z, Gen X, etc. Chris, I'll give it to you. You started researching this company really a couple of days ago, and you kind of got excited by what you saw. What is your take on the current thesis? And then we'll get into the financials with Steve.
Okay, so one of the first things I think we need to discuss before we get into the thesis on Oscar is how U.S. healthcare insurance actually works. Because I think a lot of people, especially among the young people, they're not necessarily as aware, right? So you've got 3 to 4 layers of healthcare that we have in the U.S. If you are poor, which is, just you're not making a lot of money, whatever, you are most likely on Medicaid, right? So Medicaid is specifically designed for people that are low income. Then there's Medicare, which is old people. So if you are an old person after the age of 65, you qualify for Medicare because the government said, look, we need to take care of the poor and we need to take care of the old. Then you have this giant slice in the middle. You've got 2 things there that are very important to understand. One is just plain old commercial insurance. And that insurance you can get through either buying it yourself privately, or you can go to an employer and your employer buys that insurance coverage as a group. So let's say you have 2,000 employees. Your employer says, hey, I want to get my guys coverage for this healthcare. So they go out there, they go to United Health, they go to Aetna, they go to Cigna, they go to all these guys and say, look, I need to get healthcare for my guys. I have this many people. What is the rate going to be? And then your group together, you guys cover the insurance for all of you guys. What Oscar does is a little bit different in that it works with the ACA, not American Care, the Affordable Care Act, which is another way of saying Obamacare. Okay. Obamacare was set up in a way that lets people buy insurance in the market based on certain criteria. And that criteria typically ranges from your age, right? Your location, like where you are state-wise, because you have to usually buy Obamacare at the state level, and your states actually have that. Your income level, your age. They don't use medical conditions as a point where they charge you a premium based on that. The other thing is Obamacare lets you choose the level of care that you want. So it starts off with bronze, it goes up to silver, gold, and platinum. Now, each one of those things has different caveats there. So if you're like a young guy, you don't get sick very often, you can be on a bronze plan because you're not expecting to use a lot of services. If you're an older person, or you have a condition that's going to require a lot of care, you typically want to be on, let's say, a gold or higher, because this way, you're going to be covered. These are the kinds of things that are out there right now. And the thing is, ACA is growing. Oscar's saying, look, we want to be part of this, and we want to basically disrupt how insurance is being done. Right now, everyone, and this is something that Steve could probably talk about right after this because he works in insurance. The way that it works is that the more people that actually cover the entire group, the cheaper technically it is for the entire group. But if you only have 15 people or 20 people or even 100 people, it gets really expensive, because when you go to that insurance company and you say, look, I have 100 people, the insurance company is like, I have to set everything up. I have to do all of this stuff for just 100 people. I'm going to charge you a crap ton in premiums, right? And so now your employer and you are kind of stuck in that. So what these guys are doing with Oscar Health, they're saying to the smaller guys, which is like the employers that have 5, 10, 15, maybe even 100 people, and saying, listen, why don't you just go to Obamacare, the ACA, let your members choose whatever they want, and have the employer just basically pay for that coverage, which is they just pay that premium cost that Obamacare has, right? And so the thesis that the Oscar has is, the more we encourage people to get onto the ACA from the employer side. So a lot of these guys that are employers, they're saying, look, I want to get a fixed cost. I want to know what it is. I don't want to have a contribution plan where, one person gets sick and now the entire group has to pay way more money. If all of these people are with Obamacare, then I just have to pay the insurance premiums that these guys choose, and they can choose whatever they want. So it's a very easy fixed cost. So that's what Oscar is leaning into right now. There are certain caveats that Obamacare has, like the ACA has, in that most of the people that are in ACA are younger people that have, that work things like gig work. Like right now, me and Amit were actually talking about this yesterday. And I said to Amit, you don't work for an employer, you work for yourself. Where do you get your insurance from? And so Amit's like, oh, I get it from United Healthcare, right? And the thing is, you just go every year when the enrollment period is there and you choose what insurance you want, right?
Yeah, pretty much.
And that's how a lot of people who work in the freelancing industry work. So one of the things, and I'm glad, Ronnie, you brought up the younger people, back in the day, most people had the traditional job. They had work 9 to 5 for an employer, right? And that's how you did it. Now, if you look at the creator economy, the delivery people economy, there is way more people doing gig work now than ever before.
Yeah. And
because of that, there's a huge population of people that can actually sign up to this. And Oscar's targeting those people specifically because they're like, look, these people, they're not part of any major group that's going to give them that access to the healthcare that a company would who has 1,000, 2,000 employees, but they still need healthcare. And this ACA thing could really work out. Now, one of the ways that they're really doing well to beat the other guys like United Healthcare and Aetna and all these guys is they're undercutting them by being technology first, right? So if you look at the margins that Oscar has compared to United has a medical loss ratio right now of about 87. They had some cost overruns with Medicare Advantage. But if you look at Oscar's medical loss ratio is 80%. Me and Steven, we were looking at this the other night, and I was like, how the hell do these guys have such a great medical loss ratio? What that means is that for every dollar they take in, they spend 80 cents, but they get to keep the other 20, right?
And the Aetna former CEO is now running Oscar as well.
Right. So maybe you can chime in a little bit, Steve, on this one.
Yeah, so I do insurance, but I don't do healthcare. I do corporate lines, workman's comp, and commercial package, that type of stuff. But it's very similar. And what got me interested in this is started looking at the numbers, and to take it back to what Chris and Ronnie were saying, Oscar predominantly services individuals and small businesses that are purchasing health insurance through the ACA marketplace. And they're now in 20 states with really strong presence in 3 critical states because of their size: Texas, California, and Florida. So that's huge for them. And
but one thing, Steve, sorry to interrupt, and I'm going to get better about interrupting. They're no longer in California because the costs in California were way in excess of what these guys were projecting. So they actually left California. So one of the things about them that makes them unique is that they're nimble. They're small, but they're nimble. So they only go into areas that they know they're going to be able to generate high margins. So they're not like, hey, we're going to be in California where the costs are just really expensive. And basically our medical loss ratio, when you combine it together with everything else, it's not going to be 80. It's going to be like 87, Sorry to interrupt. Go ahead, Steve.
Yeah, no, that's fine. So I did not know that they were out of California, so I need to work that into my numbers on future predictions. But the way that any insurance policy is going to work, it's what you take in versus what you pay out. And I strip away their interest and dividend income because they have assets that they're investing. I'm looking strictly at their premiums and annuity revenue versus their policy benefits, because the policy benefits are what they're paying out in claims and what they are providing in medical services, because they also offer telehealth, $0 virtual visits, and they have an app for managing the healthcare needs. Over the past 10 quarters, the premium and annuity revenue increased by 212% to $2.04 billion, whereas the policy benefits only increased 165%, which was $1.41 billion.
Right.
So the margins are improving, and the policy benefits of premium revenue was 88.8% in Q3 2022, which means that they had a 11.2% spread. But now it dropped to 75.43%. They're almost at a 25% differential. So they're becoming much more profitable on that line. And when I look at their balance sheet, this is what I love to see. They have 2.63 billion in total investments on the books. They have 2.24 billion in cash on hand. Those are two completely separate line items. And then when I strip that away with unpaid claims on the balance sheet, which is a liability, 1.47 billion, and the insurance and annuity liabilities on the balance sheet of 1.95 billion, you still have around 1.3 billion, 1.44 billion in on-hand liquidity after all of it. So this is a company that is doing very well managing their claims. And when I see AI-driven, technology-driven platforms for this, it makes me think that they're doing a better job underwriting because of how the margins are getting better. And when I look at the total revenue and I look at what the analysts are projecting for the forward growth, the other day, this was trading at just over 7 times 2027 earnings. They're expected to go from 68 cents this year for EPS to $1.96 in 2027. I mean, that's a forward earnings growth of 188%. I mean, that's huge, massive growth. They're doing over, I believe, 10 billion in annualized revenue right now, and the spreads are getting better. This is something that can continue to do this, which is very interesting. And this could start chipping away at the Uniteds, the Aetnas, all the main predominant carriers.
So let me ask you, Ronnie. They're going to do about 10 billion in revenue. Market cap is like 5 billion. Why do you think this has been underappreciated? And you can kind of get into some of the bear cases for why people would buy UNH over Oscar.
Yeah. First, to say something on that, I mean, how perfect timing is this for? I mean, Oscar's just got to be licking their lips. Their whole management team, like with the whole, UNH debacle and everything. I mean, that's just got to be like they're sitting over there, like, like Braveheart, like running down, running down the line of soldiers, like ready to go. Like let's go get it. Like let's go disrupt that. And that's their whole mission here, is to be a disruptor, to bring the technology, to reach out to the youth, to reach out to the younger generations. And if they catch some of the older generations along with it, like, hey, the more the merrier. So to the reason they've been so underappreciated is just the fact the ACA, like it possibly going away. Now, that is a huge thing. And what I would say to it is, even if it goes away, they've already like kind of like forecasted their numbers as if it was going away after this year. And then basically what they're doing to counteract that is ICRHA, which is essentially your individual coverage health reimbursement arrangement. So a lot of companies that use this are like Uber, those companies that, have these workers that are, more part-time, more like self-made, doing their own thing, kind of like that. Right. So reaching out into that sector can be a very large sector as well. And we have to remember, I just got some notes over here, by the way, but 7% of Oscar's current exposure is with ACA Affordable Care Act right now. And then the total addressable market jumps from 21 million to 96 million lives on the ICHRA. And a lot of companies are going more towards that right now, especially in preparation of potential ACA, Obamacare getting kind of knocked out with this, new bill that Trump's coming out with. So I think that coupled with they do have a current SEC investigation right now, but I've looked into this, and my real brass tacks thoughts on it is the fact that it's basically they're being investigated during COVID times. And if you read into it, I mean, they're literally I'll pull it up here. Oscar Health's stock is currently under investigation due to potential securities fraud allegations, with investigations focused on whether the company issued misleading statements to investors regarding its financial performance, particularly concerning factors like growing COVID-19 related costs and potential negative impacts on their business without adequately disclosing the information to shareholders. Who knew what was going on during COVID? You know what I mean? So like misleading statements during COVID, I mean, to me, this is just my opinion, but like to me, that just seems like real like grasping at straws type stuff on this investigation. So I don't think anything's going to come from this investigation. Surely something could. They could get a slap on the wrist. They could get a fine. A lot of things can happen, right? So that is also another little added risk that goes into all of this, is that they do have an SEC investigation underneath them, right, or on top of them right now. But I really think, it's the ACA. It's the, ACA fears going away. It's the investigation, which is.
Do you think the ACA could go away in the next 4 years? Do you think it's a legitimate fear or no? We can get Chris's take on this as well. Chris, you think?
I mean,
I'll be honest. You're not going to see it go away, and I'll tell you a couple of reasons why it's not going to go away. The first reason is it benefits Republicans who are usually very pro-business, because if you can get something like ICRA passed, that means that all of these businesses, they don't have to get commercial insurance, right? Which means that you can actually put them in the ACA, which is the Obamacare, which means that for businesses, it's great. Like imagine you're a business owner right now, you know that per year you are going to pay $8,000 in premiums for your member. Like you already know. You can write that off in your taxes and all the other good stuff. Like it's a defined amount. You already know. So businesses love that. The Democrats love the fact that it's Obamacare, that more people are going to be enrolled in something that they were the ones who architected it. So both Republicans and Democrats are for it. So that's just one thing. Now, there is a bit of a headwind that's going to be coming at the end of this year, in that during the Biden administration, President Biden said, look, we really have to help people out. And what they did is they subsidized portions of the ACA. So if you were, of the poorer part of, your income stream, but you're basically the working poor. You're not making enough to not be on, you're not making less than what you need to be in Medicaid, but you're not making more to basically have real commercial insurance. So what the Biden administration did was they subsidized a lot of these Obamacare plans. Now, by the end of 2025, those subsidies are going away. So now all these Obamacare plans, when you go to do your enrollment, it hasn't happened yet, by the way. I hope people are hoping that it gets extended. All right. But more than likely, it's not going to get extended. So those subsidies are going away. So people are hoping that, those subsidies get extended. Of course, that's what I meant. Oscar is by far one of the lowest people in the ACA, as far as I think that's what they're going to be targeting. So that when the ACA exchanges come out, they're going to try to target the lowest amount of premiums as possible, so that they attract the most amount of people as possible. Now, there's going to be a lot of people that are like, hell, I'm going to just chance it. I'm not going to get any healthcare. I'm just going to, survive without healthcare and all that good stuff. So that is a problem. So a lot of people are worried right now that people will not join the ACA, because without those subsidies, you could lose membership. And so that could theoretically hurt Oscar, so that's something just to keep in mind. I'm of the mind that people will still go and try to get healthcare, but because the subsidies are gone, they might not get one of the, the higher tier insurances, and they might just go to a bronze plan from Oscar, especially someone who's young in their 20s. When you look at a plan from, let's say, United, it could be something that's way in excess of what they typically want. But Oscar, if it's providing it for cheaper, they can pretty much go to Oscar, and their member growth can actually go up significantly. So
Right.
If Oscar is able to maintain their costs, pass on those benefits to their end consumers, where those premiums are kept at a minimum, then they could theoretically grow that way. So, but once again, this is a move on defined benefits to defined contributions. And I think that's the disrupting part that Oscar is trying to do, which is just trying to get people to join ICRA. Right now, ICRA is going to be a really big thing. A lot of employers right now are looking at ICRA as a real possibility. I mean, even like larger companies are saying, hey, maybe if we can just, get our employees to switch over to ICRA, that means that now we can understand this, So just like I said, Obamacare is not going away. The subsidy portion of Obamacare is going away. So some people were able to actually get Obamacare for free, right? So you could have picked a silver or bronze plan. And it wouldn't cost you anything, like $0 a month, but you still would have got all the benefits. Now you might have to pay more, and it's not like
when those subsidies go away, you're saying that's not like going that could hurt Oscar, but it's not guaranteed to hurt Oscar, is your point?
Correct.
Got it.
Yeah, they might be able to pull them over with, their customer service and, the ease of their product, the AI integrations, all that stuff. And then also, like he was saying, the 7% of Oscar's current exposure is with ACA. So you want to know like the real bullish case here, this stock is literally priced like bottom of the barrel. Even right now, even after the run, like bottom of the barrel, like, almost worst case scenario here. So they keep on growing ACA, and I like the ICRA, and and they grow ICRA. I mean, you're looking at something that could really just, get. I mean, you think it has hype now. I mean, you get big investors in here with those two bullish catalysts taking this thing higher. Already the partnership with OpenAI. They're already basically their costs are way down compared to UNH, like he was talking about. It's.
You think there's a lot of good catalysts coming up essentially for it?
Yes. There is some risk, like with any stock, but the biggest thing here is that it's priced to where it's like double the risk. Like
right.
they're taking in like every single like risky thing goes against Oscar, but then also, even more than that. Because I've ran the numbers and I've ran the revenue growth. Like they can go negative revenue growth for a little bit and like it's still undervalued. Like it's insane. It's insane, right? That's all you want. I mean, given like the PE is going to go way down, the free cash flow yield that people are going to pay is going to go, crazy. Like,
well, what is the revenue growth right now?
It's 9.873 billion on a trailing 12 month. Oh, so sorry. Like, total revenues, no, 10 billion. 10 billion.
It's like 20%, 30%, or on a percentage basis, how much are they growing? If you know.
Yeah, let me pull up my.
Because I know they're planning to grow EPS like crazy.
32% from 2024 to 2025, and then they're supposed to grow 22% year over year for 2025.
Got it.
Yeah.
Chris, you want to say something or no?
Yeah. So one thing, I think some of the conversation in the chat is like UNH versus Oscar. So just to clarify, I'm in both positions. Okay. And I'll explain why. I think Oscar has the ability to kind of go after that middle market. That's, that basically lets them grow. I mean, this is a really small company. It's a $3-4 billion company. Okay. That's generating really good value right now. The reason why I'm bullish on United is because if you look at the valuation on United, it's crazy low, especially considering how much actual enrollment that they have right now and that they're still growing. So one of the reasons why United took a giant dump was because of extra costs that came in from Medicare Advantage. So if you understand how Medicare Advantage works, that's the thing. But the good thing is Medicare Advantage is actually getting a bit of a boost next year in terms of total premiums that are going to be paid. So there's actually a lot of value in UNH as well. So you can actually see both UNH and Clover do well as well. And there's other ones out there, Humana, CVS, Aetna. So understanding the business models for these companies is a really important thing. The other thing that people don't know about UNH is that it's not just United Healthcare, the insurance company. They have an entire arm called Optum, where they actually have facilities and personnel and doctors and all this other stuff. So the point is, what UNH does is the insurance company funnels those people into those doctors, those healthcare groups and everything else. So they don't just generate money on premiums, they generate money on services too. So if you look at the operating income on both sides, it's actually really strong. And there's a whole lot of things that we can go into UNH with, but this is not the UNH DD. This is Oscar. So we'll talk about Oscar. One of the things about Oscar that is a headwind that we have to be cognizant of is this right here. The net promoter scores for Oscar are starting to kind of decline a little bit, right?
Can you explain NPS to people that don't know what it is?
Basically satisfaction among people, right? Like, they'll do independent surveys and say, okay, like, how does this brand compare to the other? So net
your customer service score, basically.
Yeah. Now, healthcare tends to have very bad net promoter scores to begin with.
Terrible.
Like you don't go see a doctor and like, oh my God, I love this care that I'm getting. Most of the time,
can't wait to go back.
I feel like shit and I need to go. And then the entire time you're like agitated as hell. So, you're so the point is, before, Oscar actually had pretty good net promoter scores, but they have been declining. Okay. And sometimes the focus on too much AI and not enough human interaction could be something that we have to keep in mind as well. So one of the challenges that even UNH actually ran into was that UNH was doing a lot of pre-approvals, but they were quote unquote using AI to do approvals. And sometimes the AI would reject things. And so it's kind of the same thing right now with Oscar, in that they have, they do pre-approvals on certain things, and they're trying to keep costs as low as possible. So sometimes like people don't want to deal with the chatbots. Like, trust me, I know right now I go to like certain apps and I need to speak to a person, and I have to literally be like, talk to a person. No, I can help you. Talk to a person. No, I can help you. And then eventually it'll, actually.
Dude, I was on one of those. I put on caps lock and I said representative with like 17 exclamation points. And then the AI was like, okay, fine.
Yeah.
That's what I'm talking about, bro.
So
I don't have time to waste anymore.
So like, that's one of the things that, I would say, just be careful of. The other thing is, this is just a personal thing. I'm not saying that when you look at this, like, this is like Oscar's primary care team, right? One of the things that I notice is that among all the primary care physicians, there's one MD. Everyone else is either a nurse practitioner or like or a PA, right? Which is fine. I mean, for most people at like the primary level, you don't really need, like, in my opinion, a full doctor. But with a full doctor, you're probably going to pay more money. So if you've got a bunch of people at, the PA level and the nurse practitioner level, and by the way, I know a bunch of nurse practitioners that are way smarter than MDs, okay? But you can see that they do kind of work on trying to get as much efficiency as possible. I personally have never used Oscar, so I can't really speak to like the quality of care that they're actually dishing out. And if those net promoter scores are going down, it could be a problem. Somewhere in the chat, someone said I used to work for Oscar, and their something is terrible.
Get on
like their service is terrible. Now, listen, that's very subjective, because I'm sure that people have, really great experiences, and some people really don't have great experiences. That's something that you can't really control too much in healthcare. But the thing that I have found is that the more you lean into technology when it comes to healthcare, it is efficient cost-wise, but there are times where you just need to speak to a person. And if these guys rely too much on technology, it could be a problem, because then they could actually turn people off. And so, yes, we might see a boost in enrollment right now, as this is still a growing business and a growing company, but now they're focusing more on profitability. And so they're going to try to squeeze out as much as they can in margin. And if it means that the patients at the end of the day may not get, let's say, top level care, and they get okay care, then, like I said, in the future, those enrollment numbers could theoretically decline. So that's something just to keep in mind.
And I think this is an important point, because look, I mean, if you're buying it right now purely because of the hype and the momentum and everyone's talking about it, the inherent risk is that you don't care about net promoter score, or you don't care that there's only one MD and a bunch of NPs, right? Like, so like those things are legitimate arguments. Now, they might not play out in terms of the most bearish way, but what if they do? And so I think if anyone's buying it at $21 right here, after it was at 15, even from a valuation perspective, there could be bear cases that disrupts momentum. And that's something that we definitely have to think about if you're buying it purely for the momentum itself.
Yeah. and I had one thing to add to that. So UNH, $278 billion market cap. They were well north of like 300 or 400 billion, I believe, before the big tank. So, we're talking about Oscar, less than $5 billion market cap. More than that, probably a 5 point something right now. But yeah, I mean, it's a David versus Goliath here. It's a very small guy versus a very big guy, and they're feeding off the scraps right now. But those scraps are showing on a lot of different fundamental and financial metrics that they are very, very undervalued, even at today's price. So yeah, I mean, those are very, very good points that you made. Some added risks. Some added bullish stuff. Kushner, he has ties to the Trump administration. This company was also used during COVID to, basically be a, COVID response team and using their technology. So there's a lot of bull cases. There's some bear cases, obviously. I think Amit said it perfectly. Know what you're buying. At the end of the day, you got to know what you're buying. Like,
yeah, there's gonna be a lot of
Yeah.
people that buy this purely because everyone's talking about
Yeah.
it, and we're doing this deep dive as hopefully a way to give a very holistic perspective on it. But if you buy it and it gaps down 20%, you cannot be
sell.
upset.
Yeah.
You gotta realize if you're getting into this for the hype, you could go down with the hype, you could go up with the hype. But if you're getting into it because you believe it could be a UNH in 20 years, then it's a different story.
So
I mean, I literally. Sorry.
No, go ahead, Ronnie. Go ahead.
Yeah. No, I mean, I literally bought $100K worth. I made the video and it got some, people were watching it on X and stuff. And I bought $100K. It was like $15 and some cents. And then we had the tariff bomb. We dropped down to like,
but
11.
you believed in it, which is why you held, right?
Yeah. I mean, I just bought more. I mean, I was like, this is even dumb. Like, this is even more undervalued now. Like, let me just keep buying,
So one thing to clarify, Charles Stewart said PAs and NP versus MDs and DOs. I will never be seen anything other than a doctor. Okay, I've worked in an ER. I can tell you a couple of things. I will take a nurse who's got 10 years of ER experience, a nurse practitioner with 10 years of ER experience that's seen everything under the sun, rather than a first year grad that just basically got done and is still in residency. Okay. So this whole thing with MD, I think the quality of person actually matters. I'll tell you a funny story. There was this one doctor. I worked at an inner city hospital, and one of the things you'll see at inner city hospitals is a lot of foreign grads. And this one doctor, I don't know where. I think he was from one of these African countries because he had a very thick accent. He was a smart guy, but he didn't know certain terminology like words. And I remember he came to radiology. He's like, I don't see order for thigh bone. Where is thigh bone order? And I was like, thigh bone? It's like, what are you talking about? I said, yes, it is connected to the knee. I said, the knee? You mean the femur? He's like, yes, that is what it is called. And I was like, this motherfucker doesn't know what a goddamn femur, Now, I don't know, maybe just like a moment of slip, but it just goes to show that there are people out there in the healthcare industry, just because they have a piece of paper and a couple of letters attached to their name, that doesn't mean they're going to be great providers.
Right.
Okay.
Right.
So my wife, she works with a bunch of doctors, and my wife's a pharmacist, but she knows 10 times more than some of these MDs that basically don't know crap. Right. Like, trust me, doctors, especially if you work in a hospital and you see some of the order sets that come by, you would not want to go to a hospital. Okay. So just the name itself and the title is not the way that you go by when it comes to healthcare. You actually look at the experience, and you look at the actual training and where they got their training. That gives you a much better representation of what you can actually expect in terms of care. Right. So it's not just, oh, this is an NP and this is a PA, so they're not as good as this doctor over here because they have an MD behind their name. Trust me, there's a lot of MDs that are like, and I went to school with a bunch of them that ended up going to St. George's and Ross and all these Caribbean med schools. And I'm like, bro, I've seen you get high at a frat party. I can't trust you. I can't trust you making good decisions.
Yeah, I think the quality of the actual care matters a lot more than just the title itself. Steve, you wrote an article about this, and you were pretty bullish a week ago. You didn't end up buying, though. Is there any hesitation you have on actually pulling the trigger, or was it another reason?
No, the stuff that I'm buying is taking up a bunch of capital, and I'm more bullish on other things such as Nvidia at the moment.
So that kind of is my point. Like, although you like the name, you just feel safer in an Nvidia right now.
Yeah, look, I can't buy everything that I'm bullish on.
Yeah.
And I think that Oscar has a lot of potential. There's just other things at the moment that I'm working on. And if I was in a position to add more stuff, Oscar would be near the top of the list. Like, it looks like a very solid investment. And when I go through all the numbers, very interesting.
Right.
I mean, for that table right there, I mean, when I did the article, it was trading at 7 times forward earnings. I mean, that's a lot of EPS growth. That's basically tobacco company territory.
And I'm seeing a lot of T-Doc talk. T-Doc talk. Look, T-Doc never got EPS, never got cash flow positive, never got EPS positive, never got net income positive. You know, like they're just burning cash. Like, this is a completely different stock, completely different company. They got growing EPS. They're EPS positive. They got free cash flow coming in the door. So it's completely, different. So like I get T-Doc was a hyped up name, during COVID and stuff like that. And it ran a lot. And, a lot of people lost a lot of money because they bought and then it crashed and they thought it was the future of medicine. And I don't know what it's at right now. I think it's pretty $7.
Right.
It was $285. Ouch. So
Yeah, and T-Doc was also 2021, so
yeah, exactly. So
okay, so let's end it on this. Future growth expectations, valuation. Ronnie, you have some price targets. Where do you think it can get to, and how do you kind of justify getting to some levels?
Yeah, Ronnie, before you go, I'd love to see the DCF if you want to share it.
yeah, let's do
Now
it.
you can just email it to me.
Yeah. All right. Let's pull this up real quick. All right. Can you see that? Sweet.
Yes, there you go.
So I built this. Nothing special here. Just a bunch of numbers in an Excel spreadsheet. But basically, I'm beating it up on the free cash flow margin rate. They're doing higher than a 5% free cash flow margin rate. Forward free cash flow yields 20%, or current is 20%. Forward is free cash flow is 9%. Current 187 PE. Yeah, it's a lot because they're doing 10 cents of EPS. But like we were talking about, they're about to explode to 582% EPS growth this current year, 2025, to 68 cents, which that brings their fair value to about $20.46, a little bit over where we're at right now, obviously, because we're in $21 land after hours. On an EPS basis, I'm looking at, probably, 2026, $30. And again, I beat it up a lot down here on EPS. On a discounted cash flow model, I beat it up on its revenue growth as well. I went below analyst, probably pretty well below analyst and what they're calling for. And we still get to a massive $59 intrinsic value for this on a 10-year basis, 68% under 68% current margin of safety right now. So my portfolios, when I first initially bought, I just jumped on this thing because the thing with these, when they're this undervalued and you believe in them, you gotta really jump on them. DCAing is a great tool, but sometimes when things are this undervalued, I mean, like I was calling for the gap fill. Like I was like, hey, we could fill this gap down to 13, whatever. We got within like 13 cents. And I was sitting there on X and I was like, look, we're close enough. Like, don't wait for the absolute gap fill. Like, it's okay. And some people didn't, and they missed the boat because it turned around right then and there, right before the gap fill. So that's just the thing. Like, you can't be greedy over pennies and 10, 13 cents. You gotta take action. Is anybody caring if people are buying Nvidia at $10 or $20 or freaking Palantir at $5 or $20? Like, yeah, it matters a little bit, but now at this point, I mean, you've made so much money. You're up huge. So no one's crying because they bought it at 20 instead of 5. If you are, you're being a little greedy, you know. PEG ratio is a 0.32, which is well below 1. Forward PE 27.6. This is seeking alphas grades, you know, B+ on valuation, A+ on growth. Like I said, I beat this thing up and it's still at 59. You know, annual CAGR over the next 10 years, talking 22%, handedly beating the markets, and then 15.7% on EPS annual CAGR rate. So, you know, $80 in, fair value, 140. Personally, over 10 years is a bit much. So I usually like to say like 3 years. 3 years, I'm looking at bear case 30, base case 50 plus, and then bull case 100 plus.
So 21 right now doesn't feel overvalued to you.
Nope, not at all. And you monitor it, right? We've laid out the risks. We've laid out the things that could very well go wrong for this company. And we laid it out, and you need to monitor it. You don't just buy a company and then just say, you know what, okay, cool, I'll see you in 10 years, and I don't have to listen to a conference call. I don't have to, keep up with the stock. You got to at least on a quarterly basis keep up with it, and look out for it. But yeah, I think this is a great name to DCA. Should it be 100% of your portfolio? Absolutely not. Like, absolutely not. That's not how you it's not how you invest. That's not how you sure, you could do it once and it's a great thing and it works out and you take 10,000 to 100,000, but then you do it again and then you take 100,000 right down to zero. So, it's just, you gotta diversify a little bit. The less money you have, of course, you're not going to want to have 20 stocks. If you have $10,000 portfolio, get it down to like 2 to 5, right? Yeah. Any questions on this before I unshare?
No.
That's good.
Sweet.
So here's my question to you. What are the key KPIs are you going to be looking for the next couple of years to make sure your thesis remains intact? Like, what are the main metrics you're really going to be focusing on?
I mean, I want it their back half quarters are always so bad. They miss EPS so bad. And, I'm looking for them to level out the year. Like, let's not just first quarter and second quarter crush it, and then third quarter and fourth quarter, absolutely, fail on the EPS side of things. But we did really good in the first and second quarter. I'm going to be looking at that. I'm going to be looking for that EPS to continue to grow. And I want to see them beating analyst numbers. Like, if they beat analyst EPS numbers and free cash flow numbers, then I'm only going to get more and more bullish. I mean, if they're beating the analysts, and these analysts are already bearish. So again, we got bearish analysts, and then I'm coming under them on all those projections. So just take that in mind. That projection I just showed you isn't even like a base case, I would say. Isn't even like a bullish case.
Right? Well, do you know what the highest price target on the street is? Do you know?
I think it's in the 20s.
Okay.
From like a bigger firm. Like Piper Sandler it was launching yesterday, and Piper Sandler went from like a 24 down to an 18. They're like, remain neutral, 24 to 18. I was like,
dude, whenever it runs,
and then we ran over 18. I'm like, I don't get it. Like, what do we do?
Because they need it to come back down to 18 so that they can recommend it to go to 25. It's like a weird game they play,
Yep. And last thing, I'll share one more thing real quick, because I do a lot of technical analysis and charting and all this stuff, trading wise.
Yeah, the TA on this, people are getting excited about.
I mean, it looks phenomenal. I mean, just at your basic level on the monthly chart, you have a cup and handle, or you could say a rounded bottom, right? But you are breaking out of this wedge massively, even more. Now we're up to 21, somewhere up here. We break over 24. I mean, we're really, coming over these gaps, and we're really just going to continue this uptrend. And then on a Williams percentage range basis, we're going from green. I say it, the pendulum swinging, so green to red to green, and now we're swinging back from green to red. And that's going to take us up to 45 in the next couple years. It could happen fast. I mean, if this thing really gets momentum, I'm telling you, I've seen sometimes on these monthly charts, like you've seen it on Palantir, and I'm not trying to say this is Palantir, but like it can really just go. So
yeah,
it's technical basis wise looks great on the TA, looks great on the fundamentals. There's some risks involved, but like it's being priced as if the risk already happened,
right.
and that's why it's one of those stocks. Just like how is it this undervalued? Like you just don't.
It's because people don't necessarily understand the sector and they don't understand the business. And the thing is, if you look at how insurance works, insurance is, believe it or not, very simple. You know, you take premiums in, you pay premiums out. The whatever you have in the middle is what you have to basically reinvest into the next year, and that's the float, right? And then you make money on that float. So essentially, that is how insurance companies work. Like that's why Buffett made so much money on Geico. The guy had amazing actuaries that figured out how to do risk where they would charge more than they would have to spend. And all the money that they generated in between those two numbers, they were able to take them, reinvest them, and those things grew over a long period of time. Yeah. And that's permanent capital that they have now that they can play around with. So I would say the KPIs that I'm going to be focusing on when it comes to Oscar is their enrollment rates, right? If the subsidies go away, which is something to be concerned about, and not a lot of people choose to go with Oscar, or actually the number of members starts to decline, then that's something that we have to just keep very, in line and just make sure that we're, understanding that. So if the number of enrollments, especially after the enrollment period ends and Oscar does not win a lot, then we have some problems, because then what happens is now your growth rate on your revenue is not going to be as strong, and that the cost of care might end up staying the same, in which case now the bull case starts to die. But I don't think that that's the case. I think right now Oscar's in growth mode, so this is something that more mature companies tend to have to worry about. Right now you're starting to kind of see that with some of the other ones. Like United is actually growing their Medicare Advantage population by a lot, but there are others that are losing that population. So the thing is, if you don't have those members, then you're not making any money. Now, they made a calculated move in saying we are going to maintain our margins by not taking on a lot more sick older people that need more care. United said we're going to lean into it. And so United is basically dealing with the fallout of all of those Medicare Advantage people utilizing more services. They have a couple of theories on why that's happening. One is a lot of people put off getting certain levels of treatment during COVID. And now those numbers are starting to those people are kind of coming to the hospitals and getting those services. The other thing that's in their brain as well is that since they pay more for healthcare, they want to utilize those services. So if you charge more to people, one of the things they're going to say, like, look, if I'm paying $500, $600, $1,000 a month for coverage, damn well I'm going to go out there and make sure that I do everything. I'm going to get this, that, and the other thing. So when insurance companies, the one thing that they love is they love it when you sign up for something, you never use it. I mean, imagine Netflix. Imagine signing up for Netflix, you never go on it. They'd love that, right? Insurance companies operate the same way. You subscribe or you get a premium and you never use it. And hopefully you never have to use it outside of preventative care. So the thing that's a really big benefit for United, though, is that if you look at the number of people switching from traditional Medicare to Medicare Advantage, it's been steadily growing. And these guys, they've been able to kind of grow their market share as well. So I think what we're seeing in the short term with United is actually a great buying opportunity. Like I'm talking about buying Meta in 2020 when that thing dropped to $80, like that kind of positive thing for United. So
I agree. Yeah. I think you can own both of them. You can own both of them, and even if say Oscar doesn't work out, everything just falls apart. Every single bear case is just like it's not even bear enough, right? And it could just fall apart, and you still have UNH, and then they're only going to benefit from it more than likely.
Yeah,
but they're growing like 5 to 7%. Sorry, they're growing 5 to 7% on the revenue, and like you saw how I beat up Oscar. Like we're talking $278 billion market cap to a $5 billion market cap. UNH is still growing 5 to 7% consistently, forecasted over the next 10 years. I mean, we were talking about Oscar. They could be doing 15, even 20% plus over the next 10 years if they really hit this thing on the head. And that is why it is such a high risk, low reward for all the fundamentals reasons that we talked about.
Yeah. United, the one good thing about United also is that they're vertically integrated all over the place. So they have a lot of presence. Oscar is relying on, other providers to take care of things. So just know that when you're buying Oscar, as far as I know, you don't have they don't own a specialty group that they usually just go to. Like I said, I have to do more DD on Oscar. As far as I can tell, Oscar has to keep growing its top line and then maintain its costs. If they can do that, they're going to be healthy. It's going to be a company that makes money and just keeps generating more and more profits. They have the tailwinds of ICRA. Now, there's one thing, because we have so many viewers. Let me just go on CNBC and show you guys something that was a bit of a nip slip by their CEO, who, by the way, has in the past been in a little bit of hot water for being a little too heavy-handed when it comes to political donations.
Just
letting, yeah.
Okay.
So when he was at Aetna was I think they were either investigated or they were sued because of certain political contributions that they were making. And so let me just go to it, just show you guys. So give me 1 second.
All right, while you're doing that, Ronnie, guys, you can check him out right here on Twitter and YouTube, The Ronnie Show. He makes content pretty much every single day. If you are definitely interested in Oscar, I would follow him here right now on Twitter. And then on YouTube, he does a ton of TA, fundamental analysis, all that good stuff. So you can check him out on YouTube right there in the description on that link.
Okay, so let me just share my screen. Let me see. Okay. So this was actually, and if you guys haven't watched this interview, highly recommend you watch it. Becky Quick had some really good questions for Mike Bertoli, who's the CEO of Oscar. So
the same rate or less than CPI, we had a good program.
How can that be with the way Medicaid's been?
Well, Medicaid's not part of the ACA.
Okay, so that's where there's the issue right there, is it not? Well, how do you fix that? Why, the ACA and Medicaid are related, obviously. Why do so many people need Medicaid, and why do so many states abuse what it's used for?
Well, the funding mechanism, the sharing between the states and federal government isn't very efficient.
That's what. Not only that, but they get twice as much. Right. So they start saying that we're using it for this, that, and the other thing, and they're getting, reimbursed at twice the rate, and they're using it for these crazy programs that have nothing to do with healthcare.
And the networks are not as strong as the networks in the ACA. You don't have that level of participation. And so if we could add more individuals to the current marketplace.
ACA marketplace,
75 million people in small group and middle market employers, 20 million, 21 million gig workers in the economy. If you could put those people into that pool, it gets larger and it gets more stable.
Why do you have to go to the House Ways and Means Committee to get this? Why can't you just go employer by employer and say, come to us and do this?
Because there are certain, you lose tax subsidies as an employer when you do the defined contribution. So part of what we put in that bill was or that conversation was.
Did you hear that? Did you guys hear that?
What he said, you lose coverage if you do it?
No. This part right here.
Tax subsidies as an employer when you do the defined contribution. So part of what we put in that bill was or that conversation was let's make it possible.
Did you hear that? Part of what we put in that bill.
As in, we lobbied to get this in the bill.
Yes. So basically, if you look at how Washington, D.C. works, see, a lot of people, they think that it's politicians that write these laws. It's not. It's the lobbyists that write these laws. And then they pay the politician to basically promote it. Like, hey, listen, you're going to champion this, and I'm going to make sure that your next reelection cycle, you get your cut. And so Oscar,
isn't it bullish if you own Oscar? Like the CEO's writing the bill?
If you
it's Kushner. Kushner has direct ties to Trump.
Yeah.
And he's a co-founder. He's a co-founder, and he has direct ties to to the Trump family and the administration. So I'm
Joshua
sure that
Kushner,
had a lot to do with it.
Yeah. Joshua Kushner is a brother of Jared Kushner and the son of Charles Kushner. And Jared Kushner was married to Ivanka Trump and basically has the word of the president. So, you know, it's a little bit of a, but once again, you know, you can,
They're a small guy. They're a small guy, only $5 billion market cap.
Yeah. You can argue against the ethics of it, but if you have a company that's got direct ties to the president and also to a lot of people in Congress, and they've been kind of sprinkling that funding mechanism along, then that means that, hey, there could be something there. And by the way, this is not like, oh my God, United Healthcare and Aetna and Cigna don't do the same exact shit. Trust me, they do the same thing, if not 10 times harder. Okay. So UNH just has a little, Oscar just has a little bit more pull because of who's in the White House right now. So just keep an eye on that, you know.
All right. I think this was good. I think this was hopefully people appreciated the deep dive. Ronnie, can't thank you enough for taking the time for this.
I appreciate you having me on. Super awesome.
I feel bad. I just said bet on corruption. Find out who the most corrupt. I mean, dude, if you want to find out how much Lockheed Martin is going to do in earnings, don't look at Lockheed Martin's earnings. Go to the defense appropriation bills and figure out what we're going to end up paying Lockheed Martin, and you'll get an idea and a snapshot way beforehand. Okay, so I think a lot of people they come to me and they say, I don't like when you talk about politics, Chris. Like and I'm like, bro, in this day and age, with the way that the world is, what's the difference?
No, it's fair. Hard to escape the intersections between politics and stocks as well.
And I'm sure Ronnie can tell you about because he was in the Air Force, about all the highly, highly expensive parts that we used to get.
I played the fifth.
You know, so yeah, just even in the military, like you could get like certain things. Like there's this one company, Transdime. They make like small parts, like replacement parts for like aircrafts and stuff. If you look at the pricing on nuts and bolts and all these other things that are out there, it would shock you. It would literally be like, wait, what? Like, how is this expensive? So a lot of this is
just one specific small part. It's only made by this specific group and specific contract with this specific. Yeah, it's crazy. It's crazy.
And what they do is they put that in the bill so that this way, what happens is, and you know, one of the reasons why Palantir did what they did is they actually were stuck in that they couldn't get into the defense game because these big guys basically locked them out, and they had to really lobby hard to get these big guys to basically break apart a little bit and let smaller guys like Palantir come in. So, you know, just letting you know that politics is one of those things that we may not like watching, we may not like observing because it's so dirty. But if you're an investor, understand that there are strings being pulled in all directions. And if you know who's pulling the string and what their financial gain and interest is, you align yourself with that financial interest and you'll make money. And I'll stop at that.
All right, that's it. Steve, any last words?
No, I think Oscar's going to do well, and it's going to be interesting to see what happens. I mean, look, he can siphon off the bigger competitors. As long as the premiums outstrip the policy benefits, that's the main ratio to look at. Same way if you're looking at a bank, you look at an LDR ratio.
All right, there you go. Thank you, everybody. Appreciate it. Ronnie's Twitter, Chris's Twitter, Steve Seeking Alpha Twitter, all in the description. Just want to say, I don't know if I'm buying this or not yet. I'm still, doing my DD as well. Maybe it runs away from me. Maybe it doesn't, but it's a big win for retail. And this is like the 5th or 6th, maybe even the 7th or 8th name this year that retail uniquely has been able to identify as a sort of asymmetric opportunity. And I just think there's never been a better time to be a retail investor. I mean, the level of information that's out there for free, the level of due diligence, everyone's crowdsourcing on X and YouTube, it does seem like hopefully we can find a lot more of these opportunities as well. All right.
Yeah, what's the next opportunity, Matt?
I don't know. We'll try to do a deep dive and find out. But it's been a decent year for a lot of people. I mean, Hims, this thing was at $20. Like Oscar, I don't know if it's gonna have a Hims type of run, but if it does, like it's really changing people's lives, you know.
I got me some Hims too. I was calling it out in the 18s.
There you go.
Love me some Hims.
There you go. All right, everybody. Thank you. We will see you on the next deep dive, probably next Thursday. I think I'm getting it set up for Lemonade, and we'll try to get some more deep dives over the coming weeks as well.
Don't worry,
All right.
I won't be on that one. I have no idea what Lemonade does, nor do I want to understand what
The
they do.
numbers are so bad. Oh my god.
The numbers are bad, but people are interested. So
Good
I
luck.
don't get it. People,
Good luck.
people were saying Lemonade the other day when I was talking about Oscar, and I'm like, the numbers are horrible.
yeah.
They have that same, going after the younger generation, making things smooth, good AI.
We got to do the circle one. The circle one is the real deep dive.
That
I-
thing's crazy.
I don't know why 50 billion is.
That's a bubble, bro. That's a bubble
That's
on another level.
crazy.
What if
Amit,
it's not?
did you
though?
look what I sent you about XRP taking 14% of Swift banking by 2030?
Stop
Yeah,
trying to make Fetch. Stop trying to make Fetch happen. That's all I'm gonna say. It's from Mean Girls. Did you ever watch Mean Girls?
No, I
Stop
don't
trying to
even
make
know what
Fetch
that is.
happen, bro.
Steve, you've never
You've
seen
been-
Mean Girls?
No.
You've never seen what?
You probably haven't
Come
either
on.
on it.
No, I have. I've seen Mean Girls plenty of times. You've never seen Ronnie. You've seen Mean Girls, right?
Oh yeah.
Oh, come on, Steve. Come on, bro.
I mean, come on, Steve.
Come on,
I
Steve.
watch movies like Bloodsport.
You need to watch Mean Girls, bro. That's a good movie. It's a good one.
What's the premise of Mean Girls? Let's do pop
It's
quiz.
Lindsay Lohan. She didn't fit in with the popular kids, and then they got back.
Oh
at
my
her.
God, he actually watched it.
Did he watch it?
Bro,
This
Lindsay
guy
Lohan.
doesn't know. This guy doesn't watch like real movies like Gladiator or freaking Godfather, but he's watched Mean Girls.
Mean
Dude,
Girls is
Gladiator
better.
two-
Gladiator, so good.
Dude, do not watch Gladiator 2. It was so bad. I will save
I
it
know.
for the time. So
I
bad.
We
love
need to
it.
do a deep dive on
I
Mean
loved
Girls,
it.
bro. That's
I
what we
like
need.
Gladiator too. That was good.
You liked
You
it
liked
too?
I liked it. I
Oh
liked
my
it.
I've lost
god.
respect. I lost.
I liked
I
it.
lost respect for you, man. I had less respect for you because you were the Air Force, but now it's even lower, bro.
All good.
Or as I like to call it, the Chair Force.
Hey.
Wait, what is Gladiator about?
Amit. Oh my god.
I
Gladiator
actually
is one of
don't
the
know, bro. I actually.
Gladiator 1 is one of the greatest movies ever made.
Yes.
All right, I'll watch it eventually.
Just so everyone knows, Amit's favorite TV show is freaking Dawson's Creek.
No, it's number 2.
All right.
Breaking Bad is the first one. I gotta
Okay.
give it to
all
Breaking-
right.
but
Great.
number 2 is people need
Yeah.
to invest the time to watch Dawson's Creek. It's a hell of a show.
We need to do a deep dive on the movies that Amit needs to watch.
Yeah.
Yo, okay, hold on, Steve. Have you ever heard of the band Metallica?
What?
Metallica. Metallica? Are you serious?
You did
It's not
not
Metallica.
just call Metallica.
Oh my God.
Metallica.
No, it's Metallica.
I need to stop associating myself with this guy.
But man,
immediately.
No.
Tony, if you say one bad thing about Metallica, I'm gonna flip out.
Wait, it's Metallica? I thought it was Metallica.
It's Metallica.
My buddy just saw
Metal-
them and he's
That
in here.
said it
And
was
you just disrespected him. He just saw them.
The chat 2 days
He's gonna
ago
be
told me
so
it was Metallica.
upset. He's gonna be so
I
upset.
feel like Amit did that on purpose. There's no way that you don't know that they're called Metallica.
I mean, it is what it is. What I did make the mistake the other day. I thought Hotel California came from Aerosmith.
No, you didn't.
I was like, guys, Hotel California, one of
This
Aerosmith's
is
best
sad.
songs.
Dude, there's no way that you didn't know that's the Eagles. There's
Dude,
no way.
I had no idea there was a band called I thought it was a football team. I didn't know there was another band called the Eagles. Like I really did not know that. And then I went on YouTube and I was like, oh, that's
And let me guess, you have no idea who Don Henley is, right?
is he in the Eagles?
Oh my god.
Ronnie, by the way, I apologize for any offense I may have caused by my comments around the Air Force. I'm just a hater because let me tell you, you guys got
You know how many
pampered,
times
man.
I've been said, oh man, the chair force thing. It's all good.
Let me tell you guys how bad it gets when you're in the service. All right. When you have the Air Force, these guys stay at the Four Seasons. All right. We stay at like some
Barracks.
messed up ass places. The Air Force, if you go to like their part of the base, like okay, like I was at Fort Dix in New Jersey.
Were you in
There's
the Army?
Air Force. Yeah, I was in the
Okay.
Army. And Fort Dix, you go to the Air Force side. Oh my God, you go to their gym, their freaking their chow hall. It's amazing. You go to the Army side. This thing hasn't been upgraded since World War II, bro. You
We
know.
get extra pay if we have to stay in an army base.
Yes.
That's how bad it is. It's like we're sorry. We're sorry. Hold on, have you seen the John Wicks?
Have I listened to John Wick?
No, have you seen the John Wicks, the movies?
There's zero chance.
Oh my goodness.
No.
John
I just watched the new
Wicks?
ballerina one. So good.
I know like TA Wicks, like a candle wick.
Oh, just go
John-
watch all the John Wicks.
Oh my God.
It's
John
amazing.
Wicks?
Keanu Reeves.
Oh, Keanu Reeves.
Yeah.
Mick, can you take like a month off of your life and just watch movies, please?
You know, the market wasn't open today, so I took a day off, but I ended up sleeping. I was gonna watch something, but I just ended up sleeping the whole time. So.
Dude,
Is
Keanu Reeves
Ballerina any good
has been
in the comment
so
section?
many good movies.
Yeah.
It's incredible.
I thought it was good,
Yeah.
but I also thought Gladiator 2 was good, and clearly that's
No,
not.
I agree with you on the John Wick stuff. All of them are very good.
Okay,
you
I
seen
will
the
watch.
ballerina?
I will watch Gladiator if you
Yeah.
watch Mean Girls, Steve.
Yeah.
You couldn't pay me to watch Mean Girls.
See, that's the issue. Like you're too dogmatic about this stuff. Way too dogmatic.
There's too many good movies out there for me to watch something called Mean Girls.
It's a good movie.
I mean,
It's a good
so
comedy.
so I have a quick question for Ronnie and Chris. So first, thank you for your service. Two, what's the best military movie out there? Or let me rephrase that. Maybe not military, but war movie, something to that line. I have my two favorites right now, but I'm
In
looking
my-
for another one.
For me, it'd probably be. Look, I like Black Hawk Down a lot. I think Black Hawk Down was
Me
probably
too.
one of the best ones, and there was a lot
Me
of
too.
people. What's that Mel Gibson movie? I keep forgetting right now. I want to say it's in the Company of Soldiers, but let me see.
Black Hawk Down's that's one of my favorites too.
I mean, mine is, you know, it's pretty the one that everybody loves, but
We Were
Same Private
Soldiers.
Ryan,
Saving
Private Ryan, and then for TV show though, Band of Brothers. I've
Dude,
seen
Band
that
of Brothers was
so
so
many
good.
times, so good,
Yeah.
yeah. And then even Pacific was good, and then the Air Force one they did, it was actually really good. Like less action, but it was really good that they just did.
So,
on HBO.
I have two questions. One, have either of you seen the TV show The Unit?
No,
I have.
Whoa.
I have.
You've never seen The Unit.
I have.
You're
I'll go watch it
Googling
right
to see
now.
what it is.
I'll go watch it right now.
Both of you need to, I believe it's on, it may be on Amazon Prime,
On Hulu, bro. I watched it.
definitely on Hulu. You need to watch The Unit. So the first time around when I watched it, I wasn't that big of a fan. And then my buddy who was in the 82nd said, you need to rewatch it and watch it through the lens of this is the closest you're ever going to see of how the military actually works.
No, I mean, to be honest, if you really want like real grunt level stuff, you watch like Generation Kill. I think someone put that like
I've seen that.
Or
Band,
Restrepo.
Band of Brothers or Restrepo. Yeah, Band of Brothers was like World War II, and it was kind of showing the World War II kind of vets. Generation Kill is talking about more like today's vets. Like, it's very crude, but it's pretty accurate. It's pretty
Go watch
accurate.
The Unit. It's
Yeah.
about
Yeah,
Delta.
Generation Kill is good. It was made by the same people that did Band of Brothers and Pacific and all those as well. So
And then
Really
have you
good.
guys seen 13 Hours?
Yes.
yes, oh yeah, that was a great
That
one.
was
Yeah,
that's probably my favorite one right now.
Dude, it was so good. I wish there was a 14th hour, man.
You never even seen it.
You can believe whatever you want.
There's a 0% chance you've seen it.
That was the movie on it with Libya. Remember when the special forces guys had to go and save the
The
ambassadors?
ambassador.
Oh,
Yeah.
okay. I saw the trailer for it, but I didn't watch it yet. But I saw it. I remember seeing the trailer.
Yeah, the best Vietnam movie was like We Were Soldiers, and that was
So
with
good.
Mel Gibson. That was really good.
So good. You know, Mitt's never seen Braveheart.
Really?
It's because, you know, after she broke up with me, I needed to keep my heart brave, and you know, I kind of worked on my own personal life, so I didn't have time for the movie.
someone put Tropic Thunder. Amazing war movie.
All right, we gotta go. It's time. 10:30. All right,
All right.
thank
Later,
you, everybody.
guys.
Appreciate it. We'll see you guys in
Bye.
Market Open tomorrow. Bye, everyone. Have a good one.
Go listen to Metallica, idiot.
Dude.